Hey guys, in this video, we're going to talk about the difference between market orders and limit orders. Now, this is a key part of when you are trying to place your first options trade, or actually just anytime you are trying to place any sort of options trade, be it a spread, just a regular naked option, selling, buying, whatever. You need to understand the difference between a limit and a market order. Now, when we first go in, so we're going to be on our November 12th expiration here. And we're going to go in, we're just going to act like we're going to purchase an option, a call contract here on Apple. So we're going to purchase something. So that means that we are going to buy it. And you notice the bid and the ask here. We talked about in the past in previous videos. The ask means this is where everybody's trying to sell it, or in the bid is where everybody is trying to buy it at. And you always want to look at the difference between these two spreads here, or this is called your bid ask spread. So you're looking at the difference between the two prices. So if your spread's really wide here, that means that most likely you are getting ripped off when you are purchasing this. So it means that there's usually low volume. If this, say the bid was down here for about $1 and then your ask is up here for about $200 or $2, well, that means there's $100 difference in there in between what people are trying to sell it for and what people actually want to pay for it. So you might end up actually paying $200 for this when really the price is only worth around $150 or $130 or somewhere like that. So you always want to find something with a lot of volume and where the bid ask is relatively tight. So right here we're only about, I don't know, 17 cents off, so that is fine. So we're going to go ahead and try to purchase this 150 call contract in here. And you can see down here, if you look at your Thinkorswim or your Tastyworks or whatever brokerage you have, there's usually a little keypad right here. So a little lock pad that they have right here next to your price. And you'll notice that it also has your ask here, your bid all the way down here, and also has your mid price here. So it's telling you this is the average mid price in between the spread here. And you are trying to purchase it at the highest ask right now. So this is what you're paying. And if you want to go ahead and get filled immediately, you don't have to worry about anything. You just want to get filled, not have to worry about anything. You're going to go ahead and just purchase this right here at the 236. So when you hear people talk about, oh, slapping that ask or slapping the bid, that's what they're talking about. They're talking about, I don't care. I just want to go ahead and purchase this no matter what the price is, because I need to get in now. I don't care if I have to lose. I mean, because technically what you're losing about 9 cents on here. That's fine. You're getting ripped off about 9 cents, in here, or a little more or a little less. Take a penny or two off each side. But they don't care. They want to go ahead and purchase this right at 236. I have to have this now. Same with the bid. I'm just going to go ahead and slap the bid. I don't care. I need to get out of this, or I need to sell this because I think the stock is going to go in a certain direction. So therefore, I'm just going to go ahead, hit the bid. I don't care if I'm losing cents or pennies on either side of this trade. It doesn't matter. I need to get out of this right now. So that would be a market order where it just go ahead, automatically tries to fill you at that price. So the highest what people are trying to sell it for, and the lowest of what people are actually trying to buy it for. That's what it'll fill you at right there immediately. Now you'll notice that we go back to our little lock pad here. You can see that once we actually adjust the price of what we want to pay for this, you'll notice that it's locked. This is considered a limit order. Therefore, we can move this up to around 240, or I'm sorry, we're going to go down. We can move this down here, and you can see that it's locked limit order. You can go down, and you can see that we can put this in, but it will not trigger until the mid price of this option here goes down to 231. So you say, you know what? We don't want to buy it at 236. We can probably shave some pennies off here and save us some time, because maybe we're buying a 10 lot, a 100 lot of this. Those add up after a while. A 10 lot here, we're saving $60 just trying to place this. Plus we have to pay for different fees and etc. You know what? So we're going to limit this down. We're going to put a limit order in here for 230. We're going to try to shave 6 cents off of this. So we're still trying to get in, right? But we're just trying to get, we want a little bit of an IV contraction so that it goes down. We want to see the overall underlying pull back a little bit so we can get a better price. That's what we're doing. It's being more patient rather than just going ahead. I have to have this now. I'm going to buy it. And then sooner or later, well, guess what? Well, now we just lost $60 immediately because we bought a 10 lot here and we just had to have it now. So that would be a limit order where it doesn't trigger until the stock gets here. Now, if we go up, so if we go past 236, you can put this for whatever you want. And like 250, all right, that doesn't mean that we have to wait until it gets up to 250 and we buy it. We put this in and it's automatically going to fill us at 236. These brokerages think they're helping us out by doing this, which most of the time they are, because a lot of us, we are kind of dumb when we do this for the very first time. We're like, oh, okay, well, I'm just going to set it up here. And then it fills and you go, oh, yeah, that's what I wanted. I wanted a cheaper price to buy it in. Yeah, you're right. Thank you, brokerage. So a lot of times when you try to put limit orders way up here, they will automatically just go ahead and fill you at that ask, because why would they make you pay an extra 15 cents more rather when you can just have it right now for 236. So we can do this with the bid side as well. So you can go in here, we're just going to go with sell. We'll sell the 150. You can see it's currently trading at 219. And if you go down again, same thing. We're trying to sell it at 219 and they go, well, hold up. We'll just fill you right now at 219. We'll save you 8 cents. I'm like, oh, okay. Well, thank you, brokerage. Appreciate that. But if you do come in from that 219 closer to that mid, now you have a limit order on, and you will not get filled until you get to that 223. So this is nice if you are trying to play an option and you go, you know what? I think that if I purchase this Apple call at 236, and I think you know what? I can sell it for a whole lot more. So therefore, I'm just going to keep on going up here, and instead of trying to sell it immediately, I'm just going to go up here and try to sell it up here at the 250. So I'm going to go ahead and set a limit order in here for 250. And then as soon as that option is worth 250, it automatically triggers. And if there's enough volume in there, you will get filled. Now, the thing is, when we talked about volume earlier, if your spreads are really wide and you have not a whole lot of volume, then your limit orders might not get filled. If there's tons of volume trading like water in there, it will immediately get filled. But if you have wide spreads, you will not get filled. So you will have to adjust your price on each side. So for example, we'll do a quick little spread here. Let's just say we're going to sell the 148, 145 put spread in here. Okay. So just little short put spread in here. I'm sorry, our bias is long in here. So we're basically saying that we want Apple to go up. We sold this for 34 cents. All right. So our goal is to make this expire worthless. So we want this to go down as low as it possibly can before it fills. So we're going to go down here. We're going to set it at 20 cents. So we're automatically just going to try to take 34 cents off. Well, sometimes it's hard to get filled immediately at mid price on these spreads, because now you have two different options contracts you're trying to worry about. Okay. And each of those option contracts have different widths of spreads in here. So it's sort of hard to get filled at the same time. A lot of times you have to try to fill it. You send it in and it says it's not getting filled. You have to redo it. It's going to different places all at the same time. So it's trying to figure it out. And also you have to worry about the volume of underneath of each contract and the spread width in there. So you might not get filled here at the 34. So maybe if you want to go ahead and sell this, you might have to sell it and take some off here. You might have to sell it at 32. Okay, so we got ripped off 2 cents. That's fine. But when we put our limit order in, we can put it at 20, and then it will get filled maybe if it gets down there. A lot of times when I'm playing my daily iron condors or my zero data expiration iron condors, I put my limit order in as 20 cents, 25 cents. I sold it for $1, sold it for 75 cents. I put it in for 20 cents. A lot of times it doesn't get filled. So even though it's down there and it says 20 cents and it's SPX, so there's tons of volume in there, it still doesn't get filled. So I'll just go in and I'll adjust it. You know what? I'll take a penny off and then I'll go ahead and I'll put it in there again, and then immediately it will get filled. So you have to be careful here with your limit orders, but all in all, it's a great tool to use if you are trying to not get ripped off when you are purchasing something. If you're buying something and you just really, really have to have it, and you don't care that you might end up losing money on the initial purchase or the initial sell of something, then go ahead, hit that market order, slap the ask, slap the bid, buy that 236. But if you really want to be patient, you want to wait for the market to come down to you, you think you can get in at a better price, you think you can sell at a better price, then go ahead and you want to place that market order. And that's where you're going to get that little keypad. It'll show locked, it'll say limit price, and you will not get filled unless the options contract hits that price. So you don't have to worry about anything. The brokerages, and they know what they're doing. They see the limit price. All right, we're not going to fill you until we get to that price. So yeah, that's the difference between a market and a limit order. Try to start using this, guys, in your trading. It helps out immensely, even with different call outs. You know what I mean? Hey, we're filled here. Okay, well, they got filled at 53. Well, now it's trading at 58. Well, I'm just going to put in a limit order for here for 56 because maybe it's going to come back down to us a little bit. And you know what? It does. Boom. And now we're all together. You got in at a better price. And now we're all in there together, all for, you know what I mean? None of us are really getting ripped off. So yeah, definitely try this when you are trading this week. If you have any questions, feel free to reach out and we will try to get back with you on that as soon as possible. All right, guys, thanks for watching. Make sure to check us out on our social media. We have attached links to our socials in the description, and we also have a trading service if you're interested. There's more information in the description below.